Hello, this is Rich Vessel, founder of Advanced Projections, and we're here with our July 2023 Advanced Projections Economic Report. Here's our reviews for the economic data highlights for June and early July of this year. Employment figures for June came in with another solid new jobs figure up 209,000, with unemployment moving down just a bit from 3.7 to 3.6%. We still expect unemployment will begin to gradually move upwards. At these low levels, we see a Fed staying fully focused on inflation, given this as ammunition for further rate increases. Employment is a lagging indicator in the business cycle, so it typically declines and unemployment increases after a downturn has begun. We have a chart in our written report that shows the bottoming out and hook pattern of unemployment, both in initial and continued claims in our written report. Annual CPI inflation through June was announced on July 13th with the actual reported value of 3.0%, which is just 0.1% below expectations. However, the core CPI that leaves out volatile food and energy prices was up at 4.8%, and sticky price inflation less food and energy continued high in June at 5.6%, which is still more than 2.5% higher than the more general CPI number. A declining producer price index for all commodities, including periods of high AP recession probability, also continues to signal a likely recession as commodity prices reflect declining demand and easing of supply constraints. Federal Reserve FOMC did not increase their Fed funds rate on June 14th, maintaining this key interest rate at 5 to 5.25%. We had expected them to implement another increase, but new inflation and employment numbers from June are highly likely to act again at the end of July with the FOMC meeting. In mid-June, they issued a new set of dot plot projections for 2023 through 2025, and they're still projecting a longer fight against inflation with higher rates than they had previously thought. The continuing hot employment picture is likely to confirm that scenario. The Fed's June pause came with a firm indication that they plan to increase rates at least 2 more times this year, unless something extraordinary happens with inflation. Equities markets have gained over 25% since the October 22 lows were put in, pushing through resistance levels during June's Fed pause. The S&P 500 is now solidly back in bubble territory. The bond markets reveal that smart money is still paying more attention to the Fed's signals and pronouncements. Our proprietary equity EKG is showing extreme overconfidence, even more so than in the fall of 2021. This is usually a sign of a major market top inside a bull trap. Our indicator system keeps our recession risk level at 90% plus, due to still declining leading economic indicators, continuing hawkish Federal Reserve monetary policy signals, and a deep red AP yield curve indicator. There is now one AP indicator showing green, due entirely to the collapsing price of rhodium. The APSI, which had continued to skirt the boundary between red and yellow up until mid-June, returned to full-on red by the end of June, as we expected it would in our previous report. That's because the stock indices are back in bubble territory. Here are the current underlying economic details. Year-over-year consumer price index increases and tight labor markets continue to characterize our economy. General expectations out just ahead of this June CPI announcement were for 3.1% year-over-year inflation, and it came in at 3.0%. The Federal Reserve paused in its series of rate increases but promised 2 more this year, as the underlying sticky inflation numbers are not coming down as rapidly and employment has not yet turned to a negative trend. Consumers are still spending and accumulating record amounts of debt on credit. Bureau of Labor Statistics reports unemployment continues to remain well below 4% over the past 11 months, now at 3.6%, with new job gains in June of 209,000. We'd expected those gains to dwindle faster in the first several months of this year, but there's still no strong evidence of it yet. We're expecting to see a more significant trend of layoffs begin later on in 2023. Included in our report is the BLS table showing the most recent employment situation. Right now, all employment numbers are still higher than a year ago, including labor force participation rate and total numbers of employed persons. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, right along with their 11 rate increases in the March 22 through May 23 timeframe, and within their last available FOMC meeting minutes. Look for continued small increases when the Fed FOMC returns with its next steps in the middle of summer. Their January through May rate increases came in below our expectations, but based upon their coincidentally issued June report, we still do not expect any delicacy or wavering on their part here in the rest of 2023. Expect at least one 25-point bump this summer, most likely at the end of July, and then again in early autumn if there are no unwelcome surprises during the third quarter of this year. We have a quarterly table that was issued in the Fed's June report showing exactly why to expect continuing Fed hawkishness. Note that all their projections made last March have been updated again in July to show somewhat higher interest rates and longer-lasting inflation than they previously thought. This kind of uprating of expectations has been the case every single quarter since their fourth quarter of 2021 report. Higher rates for longer means more braking on the economy, and they indicate they expect more than a full percent higher unemployment from the current 3.6% as a long consequence for 2023 through 2025. Very tepid GDP growth was anticipated in this chart as well. But the Fed has now publicly stated elsewhere that they project the U.S. to enter recession later this year. Their previous March projections were proclaimed to be effectively unchanged from December 22, but close examination shows the most hawkish FOMC members had increased their hawkishness. The new June dot plot shows the terminal rate expectations among the FOMC members jumped significantly in the quarter, up a full 0.5%, which still translates into continuing expectations for higher rates this year. Federal Reserve recession probability still reading very high, with a significant GDP decline going into 2024. And we have both that table from the monetary policy meeting and the charts from the Cleveland Federal Reserve that show the Fed's recession probability and the GDP decline that their method suggests. Within recent months, this Fed group has acknowledged the high likelihood of a recession beginning later this year. Now note, this is not a collection of opinions on their part, but a result of their own economic models using just the actions of the yield curve as the model's main input. That source, again, is the Cleveland Federal Reserve. And we added a line in the one probability chart, which shows any time their calculated probability has gone above 40%, a recession is guaranteed. And right now, their probability is actually double that 40%. In energy, at the beginning of April, OPEC and Russia agreed to an additional 1.2 million barrel per day production cut to support prices for their oil. The markets responded by moving oil up over $80 a barrel again, but that only lasted for 2 weeks. and then oil collapsed by 17% to below $70, rebounding a bit back into low 70s. Since then, there has been a basic range for WTI crude, $67 to $75 a barrel, and we'll keep an eye on global demand forecasts to see where oil could go over the next several months. But our expected volatile range for the next several months is $65 to $80 a barrel. Gasoline prices only pushed north of $4 a gallon in a few regions this spring as a higher than usual number of refineries entered maintenance shutdown periods, but have been generally moderated by declining crude prices. So the probability of high gasoline prices for the summer should have been moderated, and a significant price break for gasoline has recently materialized. We should see average pricing holding nearer to $3 than to $4 per gallon for the rest of the summer, barring anything major happening to refineries or pipelines. Just a note, we've just filled up here in Ohio today on July 16th for $2.94 for regular unleaded. In the natural gas market, there's a lot of yin-yang in the market forces that determine prices, but for now they have generally declined significantly from levels seen at the end of last summer. Production has overtaken demand again, and that should also relieve electric power production costs as natural gas accounts for about 40% of the U.S. generation mix. The first 6 months of 2023 saw solar and wind power generate more electricity than coal did, as coal-fired generation declined further, with renewables and gas-fired plants making up the difference. Gas has provided 46% of America's electricity over the past 2 months, and renewable generation has also increased. The Energy Information Agency has issued their own projections for declining gas and electricity prices in the near future, which are likely to take place as gas supplies continue to increase. Another mild winter ahead could send natural gas prices back down to historic lows. We just noticed in the latest EIA report that the underground storage, which is typically bulked up for the coming winter, they do that over the summer, are already up to the peak levels in their 5-year averages. So we should have plenty of gas on supply, and it's likely that the winter is going to be, again, relatively mild, and gas prices are going to drop back again in the fall. For equities, in early February of 2022, we gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program that March. Here in July of 2023, there's continuing evidence of ongoing moves to cash as reflected in the money market deposits and long-term bond market. People are realizing the resolve of the Fed in their long game battle against the inflation dragon. However, this month's Fed pause encouraged a belief by some that the Fed program was done. Above, we showed solid evidence that they are anything but done. The recent bond trends reflect many more Treasury instrument purchases at the longer end of the yield curve, which had continued to accelerate the 3-month 10-year yield spread through May, ending on par with records set in 1980. This key spread has contracted a bit since then, but if and when the Fed raises rates once more, that spread will open up again. Fresh news from June in the form of those 209,000 new jobs and a skipped Fed rate bump brought further excitement to the equity indices. The S&P 500 stayed above 4,300 over the past 45 days, returning to exceptionally high-risk bubble territory, driven almost entirely by retail investors flocking to technology stocks, which we claim are outrageously overpriced. These events are not likely to temper the Fed's actions to quell inflation, however. We continue to expect a few more interest rate increases and then further general declines in equities and bonds in the intermediate term. A return from the current index level for the S&P 500 just below bubble territory to warm market levels would take the S&P down to about 3,650, and a correction to the mean would be near 3,100. However, the Fed states that they are still highly resolute in their attack on inflation. That means some significant rate hikes should still be expected, beginning with the next one about 2 weeks after the release of this report. They have clearly stated what their targets are, that inflation has not fully responded as needed, and they are dead set against significantly pausing or ceasing their program too early, so as to avoid the mistakes last made in the 1970s. Further increases in interest rates should eventually translate into a decline in equity prices. Equity analysts are focusing on a return to earnings growth in the fourth quarter of this year, but if you look at this year in its entirety, earnings for 2023 will be little changed from 2022, which is no excuse for market valuations to re-enter bubble territory. More than half of the earnings growth for the fourth quarter is expected to come from just 4 companies in the S&P 500, Meta, Nvidia, Alphabet, and Amazon. This is per FactSet's most recent earnings outlook report. So our recent comments about their overly optimistic projections for the year are likely to become real by the end of the fourth quarter. The major idea here is that at this point in a business cycle, one should be very skeptical of analyst expectations. Additionally, FactSet states this week, along with their chart, which we marked in red in our written report, that, quote, the S&P 500 will likely report a decline in earnings for the third consecutive quarter in the second quarter of this year. We feel that an actual value for the second quarter will be down 2 to 4%, but their current summary of analysts says down 7%. For prices to be going up while earnings are still in decline does not say a whole lot positive for the general belief in market wisdom. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. The May number for this metric was up a bit, about 1.9%. Some portion of equity traders are mistakenly thinking the Fed is done with its program of rate increases. This form of risk capital has clearly made some serious exits from the markets, down 39% since its peak. An equity market bottom could be near on a historic basis when margin borrowing declines a full 50 to 55% from its previous high. So there is still the potential for a further decline of around 110 to 150 billion to realize the full decline from the last high of $1.03 trillion in margin debt. Our estimate for a bottom in margin borrowing is shown in our markup of a chart that is courtesy of VettaFi's Advisor Perspectives. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.